The UK stock market is probably one of the most disliked parts of the global equity market.
If you want to find the most hated portion of the developed equity market anywhere in the world, it's the UK.
That's not surprising at all, especially when you consider that while the S&P 500 has returned over 20% in the past year, the FTSE 100, which represents the top 100 British businesses listed on the London Stock Exchange, has declined almost 5% over the same period. So although the UK stock market might not be the best investment if you're looking to grow your wealth in the long run, there are a few reasons why UK stocks may be attractive to investors. First of all, as you know, the FTSE 100 is full of blue chip stocks, well-known household names in sectors such as energy, financials, consumer staples, and so on. And one thing that these stocks have in common is their cheap valuations. What this means is that they typically trade at a price lower than their real value. The reason behind this is twofold. First of all, oil companies, miners, and banks are highly cyclical industries and have unpredictable earnings. Second, oil companies and tobacco producers sell products considered unethical in the modern world from an ESG perspective. So many investors will simply just not touch these stocks, which is why they trade at a discount most of the time. This is a good thing for investors looking for value, because the FTSE 100 index has actually been trading at cheap levels historically, and it may continue to remain at low valuation levels for a while. The FTSE 100 is currently a good 4.3% away from its all-time highs. And then if you also look at the FTSE 250, there is potentially more opportunity here, as it's approximately 6% down from its highs. Also, if we look into some sectors that have been hit really hard recently, there could be some great opportunities here for UK investors. For example, real estate investment trusts are facing some challenges at the moment, and this can be a really nice sector for long-term investors who want some exposure to UK property, especially in the commercial sector, which tends to have long-term clients renting warehouses and office buildings. There are many stocks in this sector, such as Tritax Big Box, Segro, Land Securities, and so on, that are currently down since the start of the year. So potentially there are some opportunities there if you think this sector has a future of strong returns. By the way, this is just an example to illustrate a point, and it's not a recommendation, so make sure to do your own research before deciding to invest in any of these stocks. Remember that this video is not financial advice. Other shares that I noticed are down at the moment include Anglo American, Glencore, and Rio Tinto. And even in the financial services sector, there seem to be many stocks that are trading at very low prices at the moment. So again, if you see a bright future ahead for these sectors, there may be some really good gains to be made there over the long term. Another way to look at the valuation of the UK market is to look at the price to earning ratio of the FTSE 100. PE is simply the current share price divided by the earnings per share. Without going into too much detail, a low PE ratio generally means that stocks are trading at a cheap price relative to their earnings, and vice versa. Or in other words, a low PE ratio could indicate that the market is undervalued or cheap, and the high PE ratio could indicate that it's expensive or overvalued. With that in mind, we can see that the current PE ratio of the FTSE 100 is 9.8. This means that the FTSE 100 stocks are trading at a multiple of 9.8 times their earnings. Now, the average long-term PE ratio of the UK stock market is around 15. So that does seem to reflect that on average, stocks in the FTSE 100 are trading more cheaply, which means that there may be some opportunity there for investors. However, before we get too enthusiastic and load up on cheap UK stocks, it's worth mentioning that there are many reasons why FTSE 100 stocks have low PE ratios. First of all, a low PE ratio for UK stocks indicates that there is uncertainty and weak sentiment over the UK stock market and the economy at the moment. This pessimism is priced in, which in turn results in a low PE ratio. So UK stocks may have a low PE ratio because investors are expecting earnings to decline in the future. Secondly, UK stocks are known for their dividend-paying nature. What this means is that companies that prioritize dividends might allocate more profits to shareholders rather than reinvesting in growth, potentially impacting earnings growth and PE ratios. The composition of the UK stock market in terms of sectors plays a role too, as it includes a lot of cyclical stocks, meaning that they're sensitive to economic conditions. The market is concentrated in sectors traditionally associated with lower PE ratios, such as manufacturing or financial services, which brings down the average PE for the entire market. We all know that tech stocks have been the main driver driver of growth in the past 20 years. These stocks are typically associated with very high PE ratios. Take Nvidia for example. It's currently trading with a PE ratio of 167, which is generally considered high, but in Nvidia's case is justified by its superior earnings outlook. With this in mind, looking at the FTSE 100 sector breakdown, the tech sector makes up less than 1% of the FTSE 100. There isn't anything like Tesla or Nvidia in the FTSE 100 that's grown really fast over the past few years. Instead, the UK stock market is dominated by profitable, cash-generating businesses, traditional blue-chip companies which have been around for a long time and have reached maturity. This lack of growth stocks helps put into perspective why its valuation tends to be on the lower side. Therefore, given that the growth is typically in tech, does the lack of tech stocks in the FTSE 100 mean that we can't make a profit here? Well, not necessarily, because although the index is not known for providing a good return, it's worth remembering that your total return from investing is the return from the growth in the share prices plus any dividends received. And given the FTSE's reputation for a superior dividend yield, this stands as the next reason why certain investors might prefer putting their money into the UK market. The UK has a long-established and well-developed dividend culture. While other countries have improved their payouts to shareholders in recent years, few can match the track record of UK companies. The yield for the FTSE 100 is currently 3.9%, which puts it significantly ahead of most major markets. The S&P 500, for example, yields just 1.37%. So this great dividend yield makes the UK market an attractive investment for those looking to draw an income from their investments. Investors tend to pay less attention to dividends when share prices are on the rise and interest rates are low. But in tougher and uncertain times, regular payouts from solid companies, which can be taken as income or reinvested, shouldn't be underestimated. As we mentioned earlier, your total return from investing is the return from the growth in the share prices plus any dividends received. Therefore, looking at this chart, we can see that with dividends reinvested, the FTSE has returned an average of around 5.5% per year over the past 10 years. To put this into perspective, a £10,000 investment in a FTSE 100 ETF would be worth about £17,000 today. This chart by Schroders helps visualize the dividend reinvestment effect best. If you had invested £1,000 into the FTSE 100 in 1999 and left it alone, it would be worth pretty much the same amount 20 years later, if you had chosen to take out the dividends received. The line is almost flat, no growth whatsoever. However, if you had reinvested the dividends year after year, your investments would have more than doubled, as you can see from these green bars. It's also worth noting that UK investors in global equity income funds typically experience a drag from withholding tax. This lowers the distributable income for investments listed overseas, but does not affect investments in UK listed companies. Now, I know that dividends are a controversial topic and many say that actually whenever a company pays a dividend, its share price falls by the same amount. But there are cases when dividend stocks can grow massively as well as maintain a good dividend payout level. Take Unilever for example. This is a company that has been consistently paying dividends for many decades, while also growing significantly. Before I continue, I would really appreciate it if you could hit the subscribe button. It really does help my channel. Thank you. The final reason as to why the UK market may be an attractive investment is due to its defensive nature. Defensive stocks are companies which are expected to generate reliable revenue and profits regardless of the wider economic environment. In recent years, many investors have dismissed UK blue chip shares as boring, but solid companies churning out reliable dividends have proven to be well placed for more challenging economic environments. For example, utilities, consumer staples and healthcare act as defensive sectors during periods of economic downturn, and the FTSE 100 is home to some of the largest companies in the world in these sectors, such as AstraZeneca, GlaxoSmithKline, National Grid, Unilever and more. The defensive nature of these sectors stems from the essential nature of their products and services. Utilities provide essential services regardless of economic conditions. Consumer staples include everyday products that are in high demand even in tough times, and healthcare remains a fundamental need regardless of economic fluctuations. Therefore, this defensive quality can make the UK stock market an attractive investment for those looking for stability and reliability, especially during periods of economic uncertainty or downturns. The defensive nature of the stocks is also the FTSE 100's biggest weakness, as their prospects for growth are limited. Sure, they may perform better in some years, but over the long term, an index like the S&P 500 has proven to be the go-to for wealth accumulation due to its abundance of tech companies. It's also worth noting that many of the companies that are part of the FTSE 100 don't only carry out businesses or sell their products and services in the UK, they are recognized on the global stage too. In fact, almost 80% of the UK stocks earnings come from abroad. That means that the index is much more exposed to what happens in the rest of the world than at home. So a negative view of the UK economy shouldn't be a deterring factor when deciding whether to invest in the FTSE 100. Don't forget that generally it's good to be diversified across multiple international markets, as we don't know where the growth is going to come from. Personally, about 4% of my portfolio is invested in the UK market, as this is the weighting allocated by the global index fund that I invest in. Now, my own thoughts would be that if you did want to invest in the UK to take advantage of certain undervalued stocks, as well as the potential rebound in some of the sectors that we analyzed earlier, I'd probably choose a simple index fund and just keep things really simple. I would buy the FTSE 100 as a whole rather than trying to guess which stocks or sectors are going to perform well in the future. Some good funds that you could consider include the Vanguard FTSE 100 ETF with the ticker symbol VUKE, which will pay out any dividends, or you could opt for VUKG, which is the accumulation version of this fund, meaning that it will automatically reinvest the dividend it pays out back into the fund. Some other one that you can look into is the iShare FTSE 100 ETF with the ticker symbol ISF or CUKX for the accumulation version. But the thing is that even with dividends reinvested, a FTSE 100 index fund will simply not give you the sort of returns that we could get from the S&P 500. So watch this video next to learn about some of the best S&P 500 ETFs available to UK investors.